So, welcome to the final webinar in the winter session of Contemporary Challenges to American and Global Law. I'm Leah Wortham, Professor Emerita at the Columbus School of Law of the Catholic University of America. I'm the Catholic University Director of the American Law Program and LL.M program, in which Catholic University have cooperated with the Jagiellonian University in Kraków, Poland for many years. I will be your moderator. To open, I turn to Louise Leyden, the Executive Director of Development and Alumni Relations for the Columbus School of Law of the Catholic University of America, who will bring greetings from our law school.
Thank you, Professor Wortham. It is a pleasure to be here with all of you today. I want to thank Professor Wortham for her leadership for putting together this particular program and recognize her efforts to foster and cultivate the relationship with the Jagiellonian University. She is built on the deep roots established by the founder of the Catholic Jagiellonian relationship with Emeritus Professor Rhett Ludakowski, who many of you know. Catholic law values this almost 30-year relationship and partnership with Jagiellonian University. The International Business and Trade Summer Law Program, American Law Program, and LL.M in American Law have now more than 2,000 US, Polish, and other international alumni. We welcome those who are here with us today. The panelists today are superb. Gaspar and Chris are not only experts in their fields, they are beloved alumni who are dedicated to our schools. It's been an honor to get to know them, and it's my hope that through these Zoom meetings, we may grow our community, create even stronger ties with our alumni and among our alumni, and continue the dialogue on our shared global experience that the Catholic University and Jagiellonian programs have fostered. Thank you for being here with us today. We value your participation and look forward to seeing you more often. Back to you, Professor.
Thanks so much. Wojciech Bancik, coordinator of the American Law School, will welcome you on behalf of Jagiellonian University.
Thank you very much for your invitation. Dear participants of the series of webinars, it's a great pleasure for me to express, on behalf of the Jagiellonian University, the great joy that you all joined us in the online meeting, showing your interest in contemporary challenges in American law. We are very happy to see, again, such a huge audience who shares our passions and allows to hope for many common undertakings in the future. Thus, we look forward that the developing cooperation of the Jagiellonian University and the Catholic University of America, which kept developing for many years before, right now continues even despite difficult pandemic situation. Also, this position allows me to present gratitude to all the persons without whom it will never be possible for this event to happen. We are very happy that the cooperation of the Jagiellonian University and the Catholic University of America continues without the possibility to meet in person. To reassume, we are very excited with the new way to learn and to meet together, which we have hopefully successfully undertaken. At the same time, we do hope that sooner or later, we'll all meet in person during our programs or alumni events.
Thank you very much. This webinar series is a team effort, starting with the support of Dean Stephen Payne of Catholic University and Dean Jerzy Piszylinski, Dean of the Faculty of Law and Administration at Jagiellonian University. It draws on the leadership and staff of the Jagiellonian Center for Foreign Law School Cooperation, often referred to by its Polish acronym OXPO, and the Catholic University and Law School Development Alumni Relations offices, and as well as our communications office, and the help of our LL.M coordinators and LL.M graduates, Gaspar Kot and Luke Bartosik. I haven't had a chance to look at the full participant list yet, but I see some faces with their screens on, and I want to recognize three people whose faces I see. Krzysztof Oplustiel is a former director of the Foreign Law School Center, and so one of the people who is a big part of this history of wonderful cooperation. George Garvey, who was actually the founder of the American Law Program and the LL.M program. So we all need to give him a shout out to thank all the alumni who are here, should be ready to thank him. I see Professor Sarah Duggan, who's one of our regular professors in the American Law Program, and all the LL.M alumni and the American alumni too will see one of their favorites, Stuart Shept, our registrar, who everybody knows well. I'm sure when I look at the full list, I will see some other people, but those people have their cameras on. And I know that those are all people that many of you know and are glad to see with us. So This is the end of the winter series. I think you will shortly. I hope you've been able to check out on the law school's website the wonderful little stories about these that Jillian Salazzo from our media office has been putting up. And the recordings for these go up very quickly. The wonderful website at Lagolonian, if you haven't looked at it, has a complete record of the events. You can link there to recordings. It shows the bios for all the commenters and speakers. So if there's something you missed, you can go back and check it out there. That website also has the links for the spring session. We have 4 remaining webinars for the spring session. The first 3 of those, really by kind of coincidence of when speakers were available, are all on human rights related topics. And that many of ours, we've had a wonderful range of topics in this series, ones related to business and finance, a number on business law and technology. And as I said, we have the next 3 are on very interesting. The April 14th one is on gender-based violence. One of our alumni, LL.M alumni, is really one of the foremost experts on the Istanbul Convention. You probably saw in the New York Times this week the irony that Turkey just pulled out of the Istanbul Convention. And we have a really incredibly distinguished alum of ours who is the author of a textbook on domestic violence, who will then be commenting from a US perspective. So that should be wonderful on April 14th. We also have a comparison of the Black Lives Matter and Me Too movements with Mary Leary on April 27th. And in May, we have Professor Jefferson, our former Dean Jefferson, beloved by many, who will be talking about international human rights perspective on American retirement law. And then on June 2nd, we will return and have sort of a companion piece to what Gaspar and Chris are talking about today on other aspects of investment regulation and investment management. So I hope we will see you at some of those. So Gaspar, you can go ahead and share your slides now, and then I'll just make a few reminders about how we work and introduce Gaspar and Chris. I expect most of you have used Zoom or a similar video conferencing platform before, so you know about typing questions in the chat. I will be taking questions from the chat and posing them to our speakers. You can type your question directly in the chat. If you prefer, you can click the drop down where it says everyone and go to my name or Luke Bartosik's name and send them the question. And we will ask it for you if you prefer that. You also can send a private chat. If you look through the participant list and you see friends or classmates you haven't seen for a while, you can also send a private message to them. So unfortunately, I didn't look quickly. Sometimes the software doesn't recognize Polish characters, so we apologize if there's a funny character in your name. If you use just regular, use English letters when you register, that'll solve that problem. So Mr. Kot will speak for about 20 minutes. He'll be followed by a comment from Mr. Concannon, who will also lead off the question and answer period. So after Mr. Kot answers Mr. Concannon's questions, then I'll start posing the questions from the chat to either or both of our speakers. This session is being recorded, and the 60-minute webinar will be posted on CUA's YouTube channel within a few days. The series website links to those recordings, as to the law school's website. At the end of 60 minutes, I'll close the formal webinar and the recording will cease. Mr. Kot and Mr. Concannon have graciously agreed to stay on up for half an hour so we can take more of your questions. So I encourage any of you who would like to stay on for more questions and discussion to do so. So Gaspar Kot, our main speaker, is a markets, products, and structuring lawyer for UBS, the Swiss investment bank and financial services company with worldwide offices, which include more than 5,000 employees in Poland. Mr. Kot heads the asset management stream of the legal department in the UBS Kraków office. He received an LL.M from CUA in 2012 and has served as CUA JU LL.M coordinator since 2012. Mr. Kot received his law degree from Jagiellonian and is a member of the Attorneys at Law Bar. In addition to his work at UBS and helping us as an LM coordinator, Gaspar is a PhD student in Jagiellonian, so a very busy person. Chris Concannon is President and Chief Operating Officer of MarketAxess, a global electronic trading platform for institutional investors and dealers around the world. Concannon oversees day-to-day operations, corporate development, and long-term technology strategy and global data strategy. Before joining MarketAxess, Mr. Concannon was president and chief operating officer of SIBO Global Markets, where he was responsible for SIBO's transaction business, including global derivatives, US and European equity, and global foreign exchange, as well as overseeing the company's technology, operations, risk, and marketing divisions. He also was chief executive officer of the BATS Global Markets, where its first public offering, as well as its Mr. Concannon has more than 20 years of experience as an executive at NASDAQ, Instinet, and an attorney at Morgan, Lewis & Bockius, as well as the Securities and Exchange Commission. Mr. Concannon.
Leah, you're on mute.
Have I been in mute the whole time?
No, not the whole time, but it seems to come on. Yes.
Oh, sorry. Sometimes it does. So I hope you heard. Did you hear both introductions? I hope. Okay. I hope the introductions were there.
Yeah.
Okay. So we'll now turn to Gaspar to begin. And again, please remember to put your questions in the chat.
Hello, Professor. Thank you for the introduction. And hello to everybody else joining us in the webinar. Today's topic is sustainable investment, which is the new heart of the EU financial market regulation. I'm trying to switch the slides, and it actually doesn't work properly. So let me check that. Yeah, this is fine now. Thank you. So at first, I would like to give you some background and tell you what ESG is and what sustainable investment is. So sustainable investment is an investment in an economic activity that contributes to an environmental or social objective. But what is important, it also shouldn't significantly harm these objectives. And the company in which we want to invest must follow good governance practices. And what is ESG? What are ESG criteria? These are standards for operations that investors use to screen potential investments. So we can give examples of these criteria. For environmental criteria, we have climate change, carbon emission, pollution, and deforestation. When it comes to social criteria, we can talk about labor standards, social inclusion and diversity, human rights, and also data protection. Governance criteria relate to risk management, values, so company values, reporting standards that are present at the company that we would like to invest in, and transparency. To set the scene, why the EU introduced its sustainable investment regulation, we should mention the 2016 Paris Agreement on climate change, which was signed by 196 parties. And I'm happy that the US is rejoining the Paris Agreement. Also, the UN has adopted sustainable development goals. And as a result of these, the EU has introduced an action plan on sustainable finance. There are 10 main points of this action plan, which I will talk about in just a second. And the goal of these action plans is to transform the EU economy into a greener, more resilient system. And it is now EU's policy to make sustainability the heart, so the centerpiece of the EU financial system. And why is this all very important? Because it has a huge impact on financial market participants, so on companies within the financial market. And they must now implement ESG in response to this new regulation. As mentioned, the EU Commission has introduced an action plan on financing sustainable growth. The idea is to reorient capital flows towards more sustainable investments. And how is it to be achieved? So the EU has planned, and it's implementing this plan to establish a taxonomy So definitions of environmentally sustainable activities. It also wants to create standards and labels for green financial products. Investments in sustainable projects are to be fostered, and sustainability in providing investment advice should be incorporated by financial market participants. Also, sustainability benchmarks are to be developed. The idea that the EU has is to mainstream sustainability in risk management. So risk management should include sustainability when it is thought about. How to achieve that? Also by integrating sustainability in ratings, in market research, and also to clarify institutional investors and asset managers' duties to incorporate sustainability in prudential requirements. The next goal of the EU is to foster transparency. And I will talk mostly about transparency and disclosures today because I'm going to concentrate on the Sustainable Finance Disclosure Regulation. And this is to be achieved by strengthening corporate sustainability disclosure. What are the main regulatory initiatives of the EU when it comes to sustainable investment? First and foremost, the Sustainable Finance Disclosure Regulation, often used is the acronym SFDR, and this regulation puts new disclosure obligations on financial market participants on sustainability matters. And this is actually something that has already been introduced and is in force since 2 weeks. So it entered into force on March 10th, 2021. And now the regulatory technical standards, so the RTS, a level 2 regulation to SFDR, is being looked at intensively by the market. Although it's going to be implemented, it will be in full force in 2022. It is already a huge task for financial market participants to implement all the requirements of the RTS, because it details specifications for the content, methodology, and presentation of the pre-contractual disclosures and all the requirements relating to periodic reporting. The next initiative, regulatory initiative, is the framework regulation, so-called taxonomy regulation. So it gives the definitions, the taxonomy, in order to clarify what economic activities should be considered sustainable. And it focuses on environmental objectives. So when it comes to the taxonomy, it does not much include when it comes to the social and governance aspect of the ESG. The third part of the regulatory initiatives is the way how the existing regulation is to be amended. So MiFID II, UCITS directive, and IFMD is to be amended. The existing regimes will require sustainability to be a part of the organizational structure and investment decision making. This is still in draft, and the draft is currently under review by the competent authorities. What are the main requirements of the SFDR? As already mentioned, as the name itself implies, these are disclosure obligations. And what kind of obligations are these? These are obligations on websites, so publicly available to anybody who wants to get to know how a firm, a financial markets participant, includes sustainability investment in its activity. It also requires pre-contractual disclosures to investors. So investors that want to invest in green products need to get pre-contractual information on the products so that they can make sound judgment whether this product is suitable for their requirements. Also, after these investors have invested in the products, they need to get periodic reportings. So when it comes to funds, these give annual reportings, and discretionary mandates give quarterly reportings to their investors. There are two kinds of disclosures that are to be done under the SFDR. First are the entity level disclosures, and there are three main policies that need to be put on the websites of each financial market participant. So this is the remuneration policy, which needs to include information on how remuneration in this firm is consistent with integration of sustainability risks. The second policy is on integration of sustainability risks in investment decision-making process. And the third one is the principal adverse impacts policy. And this is a policy where information on consideration of principal adverse impacts of investment decisions on sustainability factors is to be presented. This is not mandatory to all companies, only for such that have more than 500 employees. For others, it's a comply or explain basis. So they may, but do not need to comply with this requirement. But if they don't, they need to explain why. Also, the firms that have implemented this policy on principal adverse impacts need to disclose if and how each financial product considers the principal adverse impacts on sustainability factors. The other level is the product level disclosures. And here, for all products, we need pre-contractual and periodic disclosures on integration of sustainability risks into investment decisions. Then we also need results of impact assessment of sustainability risks on the returns of each financial product. So we need to know how the results are affected. And the third part is the consideration of principal adverse impacts of the financial product on sustainability factors on the firm's website. Additionally, for so-called green products, so Article 8 and Article 9 products, technical disclosures are also needed. And we can move on to the financial product categorization. So we have three kinds of products. There are two kinds of green products, and beginning from down below, Article 9 products are such products in which sustainable investment is a core objective of the product. And we have a subcategory of this Article 9 product where reduction in carbon emissions is an objective. So these are the most green products pursuant to the SFDR. The other type of products is the so-called Article 8 products. And these are products that promote environmental or social characteristics. They don't have a sustainable investment objective, but they promote environmental or social characteristics. And why the names Article 8 and Article 9 products? Because the requirements for those are in Article 8 and Article 9 of the SFDR. In Article 6, we have all the other products. So there are all the products that don't promote environmental or social characteristics and don't have an objective of sustainable investment. These products can have sustainability risks integrated in the decision-making process, but they don't need to. There's no binding or mandatory requirement to consider ESG criteria when investing when it comes to Article 6 products. When it comes to the scope of the SFDR, we can talk about the entities that are in scope and the products that are in scope. So these, when it comes to the entities, these are financial market participants and financial advisors. And who are the financial market participants? These are the IAFMs, so alternative investment fund managers, UCITS management companies, so undertakings for collective investments in transferable securities management companies. These are investment firms, portfolio managers, advisors, pension providers, insurance firms. And this is a list of the major financial market participants. This is not a full list, just some examples. And as you can see, the scope is quite huge. Also, when it comes to the financial products, we have the IAFs, so the alternative investment funds, and UCITS, as already explained, these are undertakings for collective investments in transferable securities. These are also in scope, but also segregated mandates, pension products, and insurance-based investment products. So also here, the product scope is quite broad, and all these products and all these entities need to abide by the new SFDR rules. Another thing that is regulated by the SFDR, but also by the taxonomy regulation, is greenwashing. So these two regulations want to prevent greenwashing. And maybe just to explain what greenwashing is. Greenwashing is selling a product as a green product, although it's not really a product that is considering sustainable investment, has ESG criteria integrated. So this is this information given by an entity to present an environmentally responsible public image of itself, of a product. This is something that is intended to be prevented by the EU regulation. And there are two main measures to achieve that. First of all, a benchmark of objective consistency in relation to marketing ESG products has been introduced. And secondly, clear sustainability metrics and indicators were introduced that are to help to combat greenwashing. And what is the risk of a greenwasher? So of an entity that is selling products that are allegedly green, but in reality are not. So they can be confronted with claims for compensation from investors and other stakeholders for mis-selling. And this is a very huge risk. So these two regulations, SFDR and taxonomy, give the investors a clear idea of what a green product should be. So now companies won't have the freedom to say that a product is green. For example, a fund is green if it doesn't fulfill the strict requirements which are regulated in the SFDR or the taxonomy regulation. And also the SFDR and all the other regulations that I've mentioned have impact not only on EU firms, but also globally on non-EU firms, including the US firms. And there is the direct impact and indirect impact. And when it comes to the direct impact, all non-EU financial market participants that market their funds, alternative investment funds, into the EU under the IFMD national private placement rules must abide by SFDR. Also, all the firms that have funds registered in the EU must abide by SFDR because this regulation is directly applicable to funds registered within the EU. But also we have the indirect impact. And what is that? This is not strictly a requirement put by SFDR or the other regulations. This is a requirement put by the contracting parties. So if a non-EU financial market participant, for example, a portfolio manager, a PM, has portfolio management or investment advice services which it renders to EU firms that fall under the SFDR, then these EU firms that need to abide by SFDR will put contractual obligations on their counterparties, the non-EU firms, for example, US firms, and require their compliance with SFDR. So it's quite probable that a US portfolio manager providing services to EU firms will need to implement SFDR in its daily dealings. And this is basically the presentation that I wanted to give to you. And maybe to sum up what I've just said, the SFDR imposes new transparency and disclosure requirements on certain firms, and details three new key concepts, which I would like you to remember. These are the concept of sustainable investment, sustainability risk, and sustainability factors. So sustainability investment, as already mentioned, contributes to an environmental objective or a social objective, does no significant harm to any of those objectives, and the company, the investee company, follows good governance practices. Whereas sustainability risk, so the next concept is an E or an S or a G event or a condition that when it occurs, it might cause an actual or a potential material negative impact on the value of the investment. The third concept is the sustainability factor or sustainability factors. So these are the E or S factors. So employee matters, respect for human rights, anti-corruption, anti-bribery matters. These are the factors that need to be taken into account when it comes to sustainable investments. Now, Chris, over to you.
Well, great, Gaspar, that was a great presentation, and I have hundreds of questions, but I do want to quickly start with just a few comments and talk a little about how SFDR really fits in the world. And Gaspar really made this clear at the end of his presentation, the indirect impact that SFDR will have on the globe. And this is really traditionally referred to as extraterritorial jurisdiction. It's when a country or a government obviously writes a rule that has impact beyond its borders. And we've seen Europe be very successful in another area, their global data privacy regime that was passed a number of years ago. So when you think about Amazon and Google, they're all falling under this European regime on privacy, because any individual in Europe can click on one of those websites and you trigger the rule. So it's a very powerful rule that impacts investment managers, portfolio managers globally, and public companies outside of the EU as well. And that's the beauty of this rule, is it does foster a faster pace towards ESG and sustainability. And so it's an interesting and creative rule that Europe designed. Just to put a little bit of the overall ESG market in perspective, what I wanted to do is talk about the supply and demand side of this market, because it gets very interesting. And you're probably wondering, why is a guy who runs a bond market even engaged in the ESG discussion? I'll explain that. But when you think about the demand side of ESG, it's referred to as investment mandates that we're seeing. It's a pension fund or an investor who asks that their money manager allocate some portion of their investment in green or sustainable investing solutions. And we're seeing that investment mandate for ESG growing exceptionally large. It's somewhere around $1 trillion of mandate early in 2020. And right now estimates have jumped. And the expectation is all managed funds will have close to 50% of their mandate be for green or sustainable. So you're talking about multiple trillions of dollars as soon as 2025. So the demand for ESG right now is outweighing the actual supply. So you have this interesting imbalance that the demand is outweighing the supply, and the demand is coming when you think about where are investments managed globally. The largest managers of funds globally are government pension funds, and they are all around the planet very focused on ESG. And so mandates coming out of the global pension funds are driving much of this demand. The second largest category of investment funds is insurance companies, and they are answering to their own investors who are putting mandates in place. So they are driving the demand side. And then large global asset managers are also driving that. BlackRock just came out with an announcement early in 2021 about reallocating much of their funds into ESG and sustainable investments. So you have huge demand for product. And then where is the product coming from? And Gaspar kind of covered the important role that SFDR plays, and that is there's lots of people that would like to call their product, a financial product, whether it's a stock or a bond or other investment vehicle, green. Everybody wants to say it's green given that imbalance of demand, but the rules have to define the standards in which you get to claim you're green. And that's an important rule because there are, as Gaspar mentioned, there's that so-called greenwashing where people put their hands up and say, I'm green. The classic example of greenwashing is Exxon issuing a bond that cleans up an oil spill that they had, right? That's not really green from the ESG community. So yet they label it green. That's a classic greenwashing that you can see. So the supply side is trying to meet that demand side. And first, the public companies globally are all trying to satisfy a disclosure standard for being green and being ESG compliant. And there's a number of standards developing around the globe. SASB is probably the #1 standard, which is a little bit play on accounting standards, but it's the Sustainability Accounting Standards Board. They've created a fairly sizable a list of standards, basically a checklist. And a lot of public companies try to meet the SASB standards, and it's just all met with disclosure about your labor practices, disclosure about your own environmental impact, your carbon footprint. So a lot of public companies are trying to raise their standard across the ESG ranking system. My company, a public company, we're about a $20 billion company, although today we're down a little, so a little shy of that. But we're, we're in the S&P 500, and so we have lots of investors that focus on our stock, and they are demanding, and I mean demanding on phone calls, that we raise our ESG standards. So you can see where the private sector creating this huge demand is being satisfied by the public sector writing rules and standards. And then obviously everybody is falling in line and meeting that demand side. And it's working out quite well. Just to give you some stats, and I'll get to the point, why am I even here talking about green and sustainability, running a bond market? We're the largest market for green bonds. Ironically, when you hear about the supply side trying to satisfy this overwhelming demand, public company stocks are very hard to satisfy that demand because they have rankings, and not every company, most companies have very diversified businesses. So Tesla is a perfect example. They're a very green stock because they're satisfying a great deal of carbon footprint challenges that we have around the globe. Yet you have a diversified company like Volkswagen, where they have a wonderful electronic car, but their carbon footprint and how they support the carbon footprints is a little bit challenging. So is that a green stock or not? And so there's a rating system that applies. An interesting area of the financial markets is that bonds are issued with very specific use of proceeds. So you can see a bond issued by a company that is to build a green factory or a factory that has a very low carbon footprint. That can get labeled as a green bond, and it satisfies a green mandate or an ESG mandate by an investment party. And so green bonds are the #1 really issuer satisfying this huge demand. And in 2020, over 269 billion in environmentally sound or ESG related bonds were issued. And they expect in 2021 close to 400 billion in ESG related bonds to be issued. So just to put that in perspective, we've traded, and we're the largest green bond platform on the planet. We've traded 27 billion in green bonds. Part of that is we wanted to participate in the green effort. So we created an incentive where if you trade green bonds on our platform, we plant trees. And so we have a whole Trading for Trees program that we were running in 2020, and we planted over 134,000 trees in the Amazon and in Australia, 2 areas that obviously need more and more trees. So that you can see that there's this huge demand from investors for ESG investments. There's a supply problem, but it's growing and being satisfied. And then really regimes like SFDR and now in the US, there's probably more disclosure regimes coming under the Biden administration. It will satisfy the standards and the disclosure regimes around what is green and what is not. And so one question I thought I would ask Gaspar is just the standards and the growth of standards, and how do we solve the global issue of standards that are out there around standards, just around disclosure itself. And I know SFDR goes pretty far.
Thanks for the question, Chris. This is actually a huge problem. There is no one common standard across the world. So the highest standard right now is the EU regulation, the SFDR, and the taxonomy and all the amendments that are to be done to MiFID II, UCITS Directive, IFMD. This is now the new benchmark for sustainable investment, but there are no alignment rules. So there are different sustainable investment standards in the US, different sustainable investment standards in APAC, and for that, investors and also entities that introduce products on the market. So, for example, fund companies, funds themselves, they in one jurisdiction can be a green product, in the other they will not be a green product. And trying to fulfill the requirements from various jurisdictions, the various standards, is a huge endeavor of these companies. Right now, all the funds within the EU had to update their prospectuses to integrate the requirements from the SFDR. You can imagine that the amount of funds registered within the EU is gigantic, and all of them just flooded the regulators, the supervisory authorities, with their motions to update their prospectuses. Actually, fast-track procedures were introduced to encompass this demand right now to update the prospectuses. So it's a huge endeavor. But these products that are now green products, for example, in the EU, are not necessarily green products in China, in Hong Kong, in Singapore. The requirements that were introduced there, although they don't have such a high standard as within the EU, still have different requirements, and these are not necessarily fulfilled. So for each and every company that wants to promote products that it offers as green products, needs to really have a team of experts from every jurisdiction to be able to assess whether this product fulfills all the requirements. And as already mentioned, this is not an easy task.
Another challenge that I think may play out in this area, so I'll ask you around this question. It's if you think about disclosures and investing, most disclosures involve financial disclosures. Is a company profitable? What are the profits? What are the revenues? And there's a whole system globally that helps facilitate a company's disclosure of financials and the investors being able to analyze that. ESG is a much harder thing to analyze. So what is a company's obligation under this new regime in terms of disclosure? You can disclose your labor practices maybe quarterly or even annually, but if there is a material change, how quickly does a company have to disclose that change to its ESG categories? Because there's so many different categories, and those categories are really hard to disclose and describe quickly.
You're absolutely right. And I think we should distinguish here the requirements that are put on the financial market participants, right, because they are directly touched by the new regulation. So the requirements are put on these companies. But as you've mentioned, not only the financial market participants are impacted by this new regulation. Also, publicly held companies are impacted, because now all the investors, the portfolio managers that want to invest their clients' money into publicly held companies need to know whether these companies are ESG compliant or not. And they simply ask, do you fulfill these criteria that we have as an investment firm or not? And based upon that, they will rate them. and the need for benchmarks, the need for criteria to assess whether a company is green or not. This is also something introduced by the level 2 regulation to the SFDR. So it really gives you a very detailed list of requirements that need to be fulfilled to be able to assess whether an investment is sustainable or not, whether it can fall into an Article 8 category, an Article 9 category. Does it have ESG objectives? So is it an Article 9 product, or whether it promotes sustainable investment, all the criteria that we've discussed. So is an Article 8 product. This is regulated, but more also from the perspective of investment firms, funds, and not publicly held companies, which are the investee companies. So this is the next level, and these companies basically give the information that they are required by their investors. So it downstreams, it has indirect impact on these firms.
Yeah, and we've seen, at just being a public company and having investors from all around the globe, we routinely get calls, and they're just ESG calls. It's a team of folks from the company, the executive team, and most investors will go through a series of ESG related questions. So to your point, the standards, and even though you have disclosures, every investment firm is really using its own list of categories, and standardization doesn't exist in this area. And one firm may be focused on labor practices, the other firm is focused on carbon footprint. So there's really a great need for, as you call it, the standardization across what is green, what is ESG compliant, and what isn't. And then, you know, there's no bright line. There really can't be. There are some things that are clearly green and sustainable, but most companies are so diversified in what they do and their practices. It's really a rating, as you mentioned it, Gaspar. It's a rating, and what level of rating are you? Similar to, you know, credit ratings. You know, you have AAA and triple Bs, and it's all an assessment of a firm's credit rating. That's really the direction that most ESG ratings are going in, and my company right now is a triple B, ESG rated by MSCI. That's not great, by the way. So we're trying to make some improvements. But just to give you the sense, there's no regulation around that, but we're super sensitive to that rating, because there are firms that won't hold triple B stocks in their fund and their portfolio. And so you don't want to be in a situation where your ESG rating is impacting who will invest in your company.
I would have a question to you, Chris, when it comes to the new Biden administration. Do you expect any changes when it comes to law, to the regulations in the US on sustainable investment?
Oh, definitely. We're already seeing an impact. There were changes already put in place at the Labor Department and how they regulate pension funds and pension fund investment. So we'll see more and more ESG mandates moving into the pension funds. And there'll be obviously changes in the disclosure regime at the SEC and how they handle public companies in the US and how they disclose. There's already a number of things out for comment around sustainability disclosures, mandated disclosures. Right now, much of our ESG disclosure as a US public company is really a voluntary disclosure, either on our website or in our proxies. So I do see an entire disclosure regime coming through the SEC under the new administration, and obviously the news around the Paris Accord and re-entry, and certainly working with Asia. One of the things we're seeing is a huge development in Asia for green products. So part of that mandate for investing into ESG compliant product is being satisfied out of China, where we're seeing some of the largest green bond issuance that we'll expect in the coming year. So there is, globally, we're seeing responses to the ESG mandate.
And actually, I've read an article recently that the Biden administration has canceled the pipeline project with Canada. So it's a strong shift towards more environment-friendly projects. And even though I don't think that Canada liked this decision of the Biden administration.
Yeah, there's a clear theme change in administration, also out of Congress in the U.S. Around this effort, and obviously the next large-scale legislation that likely will come through the U.S. Congress is infrastructure, and obviously infrastructure, regulated infrastructure, and funding of infrastructure. Much of infrastructure can be green. And so I expect a huge green mandate within the infrastructure legislation that will work its way through Congress, and Biden will likely support in the near term. Ironically, we're a sizable player in the municipal bond market, which is local township, local school districts issuing bonds throughout the US. It's a niche market, but when you think about local water districts, they are many times issuing bonds to support a water district where they're cleaning water, cleansing water, or cleaning sewage at the local level. Those are all green bonds under the green bond, most green bond rating systems. So we're seeing a huge influx of European investment demand for municipal bonds in the US. They have no tax benefits to the European investor, ironically, but the fact that they're satisfying that green demand, because at the local level, it's much easier to have a use of proceeds for very green activity, like a water district. So we're seeing a ironic use of proceeds is satisfying that international demand.
Well, thank you both so much. That's terrific. We have about 8 minutes before we close the recorded part, but we then just seamlessly go on into the unrecorded part. So we have 3 questions in the chat now. So please, other folks, let us know what questions you have. The first question I'm going to pose is from Sarah Duggan, our professor, who also, of course, is our head of our Center on Corporate Responsibility, among other factors. So I know this is somewhat up her alley as well. So she said, you've discussed some fairly well-defined criteria for environmental areas, Article 8 and Article 9 green products. Are there comparable definitions or requirements regarding labor exploitation or human rights more broadly?
The short answer is no. And to explain it a bit in more detail, there are criteria when it comes to the social aspect of the sustainable investment, but still these are not as well defined as the environmental objectives. So the Article 8 and Article 9 products, they do concentrate more on the environmental aspect, but still, as I already mentioned, these products can also promote social characteristics, and these characteristics are defined in more detail in the Level 2 regulation. So there is some regulation in this respect. In the RTS, so the technical standards of this regulation. But I would say that for now, especially because the taxonomy regulation only touches upon the environmental aspect, this environmental criteria is number one when it comes to the sustainable investment regulation.
Thanks.
I
George
would
Garvey.
Sorry, Clay, I would just add,
Chris. Yeah.
when you look at ESG from the corporate level, obviously the E for environment is quite easy to define. And what is your carbon footprint? What impact do you have on the environment? What impact, positive impact, can you have on the environment? Social responsibility is slightly more difficult, but some perfect examples: labor market. How do you treat your labor? How do you contract with your suppliers and their treatment of labor? So those are things that work into social responsibility. Just what is your minimum wage is part of the satisfaction of social responsibility. And then on the governance side, it's really just board and governance of your ES policies. So it's very hard, but what we're seeing, it's very easy to see green bonds and green related stocks and investment strategies. Social responsibility gets very difficult other than within the corporate framework. We are seeing social responsible bond issuance. So bonds with specific proceeds for social responsible endeavors and building homeless shelters in different areas. And so we are seeing early days of social responsible bond issuance to try and satisfy the S piece of the ESG.
And maybe to add to that, as already mentioned, the S part of the ESG includes diversity and social inclusion. So companies that are more diverse have a higher percentage of managers, senior managers from different cultures, different ethnic origin, also include women in a higher percentage. They get rated better.
So this is a perfect transition to the next question, which I want to direct to both of you. So, and Chris already started to address. George Garvey asked a question that is really echoes some of what Sarah said, but then went on to these points. I understand the current interest in the environment, but it seems that the system that Gaspar has described de-emphasizes social and governmental aspects of ESG. When Chris described part of the Italian system, for example, it places emphasis on labor standards. I also have questions about the lack of emphasis on diversity and inclusion included in disclosure requirements, which of course he was anticipating your comments, Gaspar, which is what you're just now talking about. So Kate is the one who controls the recording button. So we'll go ahead and have you answer this question, and that'll probably run a little past 2 o'clock. And when you're finished with that question, I'll close the recording, but we'll go ahead. So Chris, I'll let you respond first, and Gaspar, on this broader question about inquiries you're getting that go to these broader questions of diversity and inclusion. And Chris, when you mentioned infrastructure, certainly infrastructure will have a lot to do with labor standards, I'm sure, as well, not just environment. So Chris?
Yeah, so let me be clear that the diversity is a critical part of your rating for ESG. While labor standards are important, they're harder to define. A company affirms diversity and how you disclose diversity, and really what you're being judged on is diversity improvement. So it's one thing to have a low diversity rating, but if you're not improving that diversity, your score goes even lower. So diversity is the central piece of the S. I will tell you, it's the #1 focus from the private sector that we're seeing, particularly in 2020, where so much has been highlighted on diversity and the lack of diversity in certain organizations. So by far, diversity is the #1 critical disclosure piece. We're expected to disclose diversity at multiple levels, not just at the board level. The expectation right now is if you don't have a diverse board, you're going to have a problem. But across the management team and then across the full employee base. Now, diversity will bleed into your supply chain. So you're expected to understand the diversity and the diversity goals of your supply, your critical vendors. And so we're seeing diversity and diversity statistics make their way into the vendor relationship. So if I go to Amazon and sign up with AWS, they become an important vendor of ours. We need to know that Amazon is committed to diversity, and that makes its way into our public disclosure. So I will tell you, the S is truly diverse, and diversity and a critical piece of satisfying the rating for S.
Thanks. And so Gaspar, you go ahead and give your response, and then Kate, when I'll close the recorded part when Gaspar is finished, and then we'll just move right on to other questions.
When it comes to the other aspects of ESG, so the S and the G, they are still important, but right now I think this should be treated as a step-by-step process, where at first within the SFDR world, the transparency was put at first place, and taxonomy puts the environmental part as the most important aspect. And I think that the rest will come shortly after. But still, as already mentioned, these product categories, the Article 8 product, the Article 9 product, they also include the S criteria. And as already mentioned, these two criteria, the E and the S, need to be included in sustainable investments, but also the G, so the good governance. This is something that simply needs to be followed, and these practices, the good governance practices, need to be disclosed. So these are various policies that are implemented within the companies. So this is with respect to risk management, as mentioned, transparency, and other reportings. So I would say that because the environmental aspect is the easiest to market, and I think this is also currently the most hot topic of the three parts of the ESG criteria. This is put as the most important one.
Thank you, Gaspar. So I think Luke will put in the chat reminding you where you can register for the spring session. We really hope we'll see you, but we are going to now, Kate's going to turn off the recording button, and we're going to move